Investing can feel like you're just drowning in data. But what if you could cut through all that noise? What if you could analyze a company in just 5 minutes using the same kind of thinking as legendary investors like Warren Buffett? Well, that is exactly what we're going to do today with Eversource Energy. We're going to use a really simple checklist to figure out if this is a wonderful company at a fair price or maybe, just maybe, a potential trap. Does this look familiar? Yeah. The second you look up a stock, you get hit with this wall of financial jargon. PE, ROE, PFCF. It is enough to make your head spin. But here's the secret. What if you could just ignore 99% of this and focus only on what truly matters? Let's break it down. Okay, this is our roadmap. It's just 4 simple questions that get right to the heart of any great investment. First, is the business actually making money? Second, are we paying a fair price for it? Third, does it reward us, the owners? And finally, maybe the most important question of all, what are the risks? So let's apply this framework to Eversource. First up, profitability. Before we even think about price or dividends, we have to answer the most basic question: is this a healthy business? Because a great investment always starts with a great company. So let's pop the hood on Eversource and see what we've got. This number right here, 10.35, this is our first big clue. It's the return on equity, or ROE. And here's an easy way to think about it. For every single dollar that shareholders have invested in this company, Eversource generates over 10 cents in pure profit. A consistent double-digit ROE like this, that is a very strong sign of a well-run, profitable business. And here's the bigger picture to back that up. We're talking over $13 billion in revenue and almost $1.7 billion in profit. It is crystal clear that Eversource is a money-making machine. So for our first question, is it profitable? That is a definite check. So we've established we have a profitable company. That's great. But like Warren Buffett always says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that brings us right to question 2. Is the price we're paying today fair? Okay, to check the price, we'll use the classic PE ratio. It just tells us how much we have to pay for each dollar of profit. Right now, Eversource's PE is about 15. But look at this. Its average over the last year was way up there, over 20. This suggests the stock is actually trading at a pretty big discount to where it's been recently. It's kind of like finding a quality item that's suddenly on sale. And you know what? Other clues are pointing in that same direction. The price-to-book and price-to-sales ratios are also ticking just a little bit below their recent averages. Now, it's not a screaming, once-in-a-lifetime bargain based on these, but it does reinforce the idea that we probably aren't overpaying right now. So that's 2 for 2. All right, the company is profitable, the price seems fair, but does it actually reward you, the owner, for holding onto its stock? This brings us to the power of dividends. We're talking about cold, hard cash paid directly into your pocket. Just look at that number, 27. This is the kind of figure that gets long-term, value-focused investors really excited. So what does it mean? It means that for 27 straight years, think about that, through recessions, market crashes, global crises, all of it, Eversource hasn't just paid its dividend, it has increased it every single year. That kind of consistency is just a powerful signal of a durable, shareholder-friendly business. And we're not talking about tiny symbolic increases either. The dividend has been growing at a really healthy clip of over 5% per year. That means your income stream as an owner has been consistently growing faster than inflation. So far, the picture for this company looks pretty great. But a good investor never, ever falls in love with a story. Our final step is the most critical one. We have to become skeptics. We have to actively search for the problems, the risks, the red flags that might be hiding just beneath the surface. And right away, we find a potential warning sign. This number, 1.85, is the company's debt-to-equity ratio. So what this ratio shows us is how much the company is relying on borrowing to finance itself. A number like 1.85 means it has almost twice as much debt as it has equity. Now, for a capital-intensive company, like a utility that has to build power plants, this isn't totally unheard of, but it's still high enough to make us pause and ask a really important question. Can they actually afford all this? That high debt level forces us to ask an even deeper question. With profits looking good and dividends going up, is the company actually generating enough cash to support everything? And this is the number that just stops you in your tracks. This is the price to free cash flow ratio. Remember, free cash flow is the actual spendable cash a company has left over after paying for everything. A negative number here is a major, major red flag. Let's look at the raw number. Over the last year, Eversource burned through $45 million in cash. This means that after all was said and done, more cash actually went out the door than came in, and you simply cannot pay down debt or fund a growing dividend forever if you aren't generating cash. This is a genuinely serious issue. All right, we've seen the good, we've seen the bad, and we've seen the potentially ugly. So let's put all the pieces of our 5-minute investigation together and see if we can come to a final verdict. So here it is, our final scorecard. On the one hand, you've got a consistently profitable company that seems to be trading at a reasonable price, and it has an absolutely elite, world-class track record of rewarding its shareholders. But on the other hand, it's carrying a heavy debt load, and, most critically, it's burning through cash instead of bringing it in. And that brings us to the ultimate investor's dilemma, doesn't it? Do you bet on that proven history, the profitability, the elite dividend, or do you stay away because of the very real risks of high debt and negative cash flow? Is this a wonderful company facing some temporary problems, or is it a dividend trap just waiting to spring? This 5-minute check gives you the crucial questions. The final answer? Well, that's up to you.